What's up, everyone, and welcome back to the Web3 Daily. Let's get into it. To be honest, the market lately has been putting everyone to sleep. The bulls and bears are just locked in this tug of war at key levels. Bitcoin is hovering around the $110,000 mark, while Ethereum is looking a little soft, fluctuating around $4,300. The overall fear and greed index is sitting in fear territory, which tells you that most people can't get a clear read on the direction and are choosing to wait on the sidelines. A lot of folks are wondering, is this the calm before the storm, or just a much-needed halftime break after a big run-up in the bull market? My personal take is that, at this stage, simply watching macroeconomic data or what the Fed is doing isn't as effective anymore. The market's focus is shifting from the external environment to internal fundamentals. In other words, whichever ecosystem or project can deliver something truly impressive right now will be the one to attract the limited capital still in the market and carve out its own path. So, even though the broader market looks dead, there's no shortage of structural opportunities. Alright, let's kick things off with the hottest topic, making waves across the internet today. And the star of the show is someone you might not expect, the Trump family. Just yesterday, a project called World Liberty Financial, with the ticker WLFI, went live. And you heard that right. This project is directly linked to members of the Trump family. The moment this coin launched, it added over $10 billion in on-paper wealth to the Trump family. $10 billion. What does that even mean? It means that in a single day, a brand new coin created a valuation 10 times that of a unicorn company. But the devil is always in the details. The project claims it wants to build a platform for financial freedom, yet its website crashed shortly after the token launch, and its white paper is incredibly vague. More importantly, the project team is anonymous. The only connection to the Trumps is that they sent a huge amount of tokens directly to wallet addresses belonging to members of the Trump family. The price action that followed was a wild ride. The WLFI token pumped massively after launch, and then dumped just as quickly, with its market cap evaporating by over 90% in a short period. Let's be real. This was a carefully orchestrated capital game built around a top-tier celebrity and their political halo. This whole situation is a bit tricky. On one hand, you have a presidential candidate, or even a sitting president, giving the entire crypto industry a green light and creating a favorable policy environment. On the other hand, their own family's enterprise is launching a token to cash in on that influence. When you put those two things together, it's hard not to read between the lines. For us, as investors, this signals the potential formation of a new, extremely high-risk sector, what you might call political finance or polyfi. You are no longer just investing in a coin's fundamentals. You might be betting on the future of a political dynasty, on the direction of policy, and the waters there run very, very deep. Okay, for our next story, we need to talk about a major move from the regulators. For the past few years, the biggest headache for the crypto space, especially for projects and exchanges in the US, has been the regulatory tug-of-war.
The two giants, the SEC and the CFTC, have been constantly battling over who gets to be the top cop for crypto, which has left the industry with blurry standards, forcing everyone to walk on eggshells.
But yesterday, in a truly unprecedented move, the two of them actually sat down together and issued a joint statement, which immediately sent shockwaves through the industry. The core message of this statement, when you translate it from regulator speak, is this: they both confirmed that the existing legal framework does not prohibit registered exchanges. We're talking the big leagues like the NYSE and Nasdaq from listing spot crypto assets. Let that sink in for a moment. This is a huge deal. It's basically a massive green light for the old money on Wall Street, telling them, you can come in with confidence now. The compliant path has been paved for you. The potential here might be even bigger than the approval of the Bitcoin spot ETFs. An ETF, after all, is still one layer removed. It's a financial derivative. This statement, however, points directly to the crypto assets themselves. This means that, in the future, we could see a major token listed directly on the Nasdaq, trading right alongside stocks like Apple and Microsoft. The amount of liquidity and legitimacy this would bring to the crypto market would be unprecedented. So, in a way, the years-long regulatory turf war has finally come to an end, and in doing so, it has pushed open one of the most important doors for cryptocurrency to truly enter the mainstream. Alright, moving on from regulation and politics, let's dive into some hardcore tech. Solana just made a huge move with its Alpenglow upgrade, which officially passed its governance vote yesterday. And let me tell you, This isn't some minor patch, this is like swapping out a tractor engine for a rocket engine. The absolute core of this upgrade is slashing the transaction finality time from over 10 seconds down to under 150 milliseconds. What does 150 milliseconds feel like? It means that, in the blink of an eye, a transaction is permanently confirmed and irreversible on-chain. This near-zero latency experience has immediately whetted the appetite of those Wall Street firms that live and breathe high-frequency trading. On top of that, what's even more impressive is that it also slashes the operating cost for validator nodes by a whopping 98%, from $60,000 a year down to just $1,000. That's like lowering the barrier to entry for securing the Solana ecosystem from climbing Mount Everest to just stepping up your own front porch. Faster and cheaper, the combination of these two advantages is a lethal attraction for institutional capital that demands extreme efficiency and low costs. So, as you can see, technological breakthroughs ultimately get reflected in price expectations. After this upgrade passed, the odds of a spot Solana ETF getting approved in the first quarter of 2025 have reportedly skyrocketed to 75%. We're already seeing analysts raising their price targets for Solana to $300 or even $360. When I saw this next piece of news, my first reaction was, this move by Coinbase is brilliant. It's like they've built a crypto Trojan horse specifically for traditional financial institutions. They're launching a new futures product called the Max 7 plus Crypto Equity Index Futures. Simply put, it bundles together the two hottest things on the market right now. On one side, you have the tech giants like Apple, Google, and Nvidia, the so-called Magnificent 7 stocks. On the other, you have the spot Bitcoin and Ethereum ETFs issued by firms like BlackRock and Fidelity. For those fund managers who want to invest in crypto but are afraid of the high risk and having to justify it to their board, this product is perfect. They can tell everyone, I'm buying a basket of tech stocks to track technology trends. But in reality, that basket has quietly been stuffed with exposure to Bitcoin and Ethereum. It subtly shifts the narrative crypto assets from a high-risk alternative investment to an indispensable part of a tech and innovation portfolio. So this isn't just a financial product, innovation. It's a very clever market education and a user penetration strategy. It provides a lower risk and more compliance-friendly on-ramp for traditional capital to enter the crypto space, which shows that cryptocurrency is integrating into the global capital markets in a smarter, more mainstream way. After discussing all the exciting tech and financial innovations, we need to pour some cold water and look at the dark side of this industry security. According to the latest security report, this past August, the entire crypto space lost a total of $163 million due to hacks. But there's a trend in this report that I think deserves our attention even more than the amount of money lost. And that is, the hackers' attack methods are undergoing a very significant change. In the past, hackers preferred to attack smart contract vulnerabilities in protocols that was a pure technical battle. But now they're finding that attacking code is getting harder and it's much faster to directly attack the vulnerabilities in human nature. The report mentioned a classic case. A Bitcoin whale was tricked into giving up $91 million worth of Bitcoin through a single social engineering attack. No code exploits, no platform hacks. It was purely through deception that they got him to hand over his private keys or permissions. This trend tells us that, in the world of Web3 security, the weakest link in the chain might not be the code, but each and every one of us, users. Therefore, in the future of the security space, the focus might not just be on code audits. User, security, education, on-chain asset, insurance, and even real-time monitoring and warning systems for phishing sites. These services that target the human element will become increasingly important and could even give rise to new unicorn companies. For this next piece of news about the Ethereum Foundation, I guess many people's first reaction to the headline will be, are the officials dumping on us? Here's the story. The Ethereum Foundation plans to sell 10,000 ETH, valued at around $43 million, to fund the ecosystem's future R&D and development. When I saw this news, I actually felt the opposite. This is a sign of the Ethereum ecosystem's maturity. No healthy long-term organization should bet all of its reserves on a single asset. Undertaking moderate asset diversification, converting some crypto assets into fiat to pay salaries and R&D expenses is a very professional and rational financial operation. And honestly, 10,000 ETH, for a market that now has tens of billions of dollars in daily trading volume, is just a drop in the bucket. The market is fully capable of absorbing it, so there's no need for everyone to overreact to this kind of news. A healthy bull market isn't afraid of selling pressure, it's afraid of a lack of buying support. This kind of orderly, transparent selling for the sake of ecosystem development actually shows that the project team is diligently working, not just thinking about pumping the price. For our last story, let's talk about a more distant but perhaps grander topic, AI plus Web3. Has anyone ever considered that in the future Web3 world, the largest user group might not be us humans? The venture capital arm of payments giant PayPal, PayPal Ventures, just led an $18 million funding round for a company called Kite AI. So what does this company do? In simple terms, it's building decentralized infrastructure for AI agents, or AI bots. It allows these AIs to have their own identities and assets, and to transact securely and autonomously on the blockchain. A giant of PayPal's caliber, when they invest, is looking at the trend 5 to 10 years from now. They are betting that on the future internet, the main characters won't be us humans, but hundreds of thousands or even hundreds of millions of AI agents. These AIs will help us manage assets and conduct transactions, and the collaboration and settlement between them will require a neutral, trustworthy underlying network, and that's the opportunity for Web3 and blockchain. Once this trend takes shape, the demands on blockchain performance will be exponential. The TPS we discuss now might be just a drop in the bucket. So, this small step by PayPal could be a giant leap for the future integration of AI and Web3. This is a sector that deserves our long-term attention. Alright, that's all we have for today's Web3 Daily. If you found this helpful, do me a favor and hit that like button to show your support. Every day, we're here sorting through the noise to bring you the most critical information in the Web3 world, the news that's closest to wealth, hoping that by curating this content, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive registration links for major exchanges down in the comments section for you. These come with high commission rebates we've negotiated for our fans, hoping to save you some costs along the way. Let's all stay rational, move forward steadily, and get wealthy slowly together in the Web3 world. May all of your crypto assets grow steadily. We'll see you tomorrow.